Hi, everyone. Today I want to talk about my philosophy on savings. I have three different tiers of savings that I use. I use a standard high yield savings account, I use something called Worthy Bonds, and I also use a market based bond and index portfolio that I consider to be a little bit more risky, but also has a greater potential for gains than the first two. So I use a three-tiered savings system. And as always, there'll be a little bit of jelly at the end, which is something I enjoyed outside of finance. All of this information is for entertainment purposes only. Consult your financial advisor before making any changes to your portfolio. Welcome to the Portfolio Bulletin. Let's get started. The first part is CIT Bank. They are a regular savings bank. They have an online presence and they offer 1.55% with any balances above $25,000 or a minimum of $100 deposited monthly. This is what their online platform looks like. You can see here, I have a Savings Builder account. It's evaluated on the 27th of every month, which is when they look at the balance of your account and determine the amount of interest you earned for that month. If you click up here on activities, it'll take you to this page. And here it'll show you your transfers. So the $100 needed to maintain the high interest rate that they offer. And then on the 31st of this month, my interest was deposited. So as I mentioned before, on the 27th of the month, they look at your account and determine how much interest they should pay. And then at the end of the month, they pay that interest prior to the next month. Up here, you can see the interest rate that was paid and the current interest rate. So due to the Fed lowering rates, the current rate did go down a little bit from last month, but that was expected. The next platform I use is called Worthy Bonds. You can see here they offer bonds to American businesses. They pay out a 5% annual interest rate. And I'll show you a little bit later. It works out to be a little bit more than that. And then they are a 3-year term for their bonds, but they are completely liquid. You can buy and sell their bonds at any point, which makes them ideal for a secondary savings account. So let's talk about how Worthy Bonds does business. So they do $10 bonds and they loan those to small businesses. But the key here is that they are asset-backed small businesses. So that means if these small businesses were to fail, they could sell all their assets and recoup the money from the bonds. If you go to their About page, you can see a little bit about the company. It's Worthy Pure Capital. It's a subsidiary of Worthy Financial, Inc., and they are registered with the SEC. These are SEC qualified bonds, and their goal is to crowdfund small businesses with bonds. Here's their mission statement. At last, even the smallest investors can benefit from strong financial returns usually reserved for larger institutions and wealthy investors. If you want to see more about the About page, I will link it below. So if you get an account with Worthy Capital, this is what it will look like. They do have two funds at this point because they sold out of the bonds in their first fund, so they started a second fund. You don't have to move capital between these funds because they do pay interest daily and they do pay it down to the cent. It's no longer done by the bond. You can see here what my interest has been. I've gained $150 worth of bonds and then $62.71 worth of interest. And this is my current portfolio value. And my initial investment is here. And then you can go over to Worthy Capital 2. If you were to start a new account, it would be in Worthy Capital 2. That is where they're selling new bonds. And you would be able to do the same thing as Worthy Capital 1. They were just capped by the number of bonds that they applied for with the SEC. And then you can go to interest reports, which I will do on my main portfolio. And here's what that page looks like. So they do reports by yearly, monthly, weekly, and daily. So you can see here they average. So for this month, there's only been 2 days, and this is the amount that I've received for those 2 days. Then for April, I had $44. For March, I had a little bit more because I did transfer some money over to Worthy 2 because they weren't offering interest down to the penny at that time, but they have since updated. Then you can go over to the weekly. You can see for the 6 days of this week, $8.80. Last week, $10.30. And it goes down from there because they do pay down to the cent, so it increases each week. And then you can go down to the daily and you can see interest paid. It goes up by 0.0002 cents each day. Going back to the weekly, I understand that this doesn't look like a ton of money, but if you compare this number, my weekly number, to my high yield savings, I'm receiving about the same amount weekly as I am from my high yield savings each month. So it is generating a much higher return than the high yield savings. So here I did a little bit of hasty math just to show how these numbers work out. This is my current balance in Worthy 1. This is the daily amount that I received. And then this is that number multiplied by 365. So that's how much money I should receive in 1 year. And then if you do the rate on that, it's a little bit over 5%. And then I did the daily amount divided by my total account value. And then I multiplied that times 100. And it worked out to be, again, a little bit over 5%. And this is assuming that my daily value does not go up at all, which I just showed you is not the case. It does go up each day a little bit. So the effective return is actually over 5% due to those daily compounding rates. Here's the final piece of my savings portfolio. This is where I would pull money from last if I needed to pull money out of savings. And you can see here, I have some in the markets. VIG is a little bit more stable than the S&P 500. Midterm bonds consists of some municipal bonds, some corporate bonds, and some government bonds. Bank balance sheet, this is like mortgage-backed securities and things of that nature. Realty Income Corp, I've talked about before. This is the real estate aspect of this portfolio. These are some other various bond indexes I have added to this portfolio. Long-term corporate bonds, and then a couple of other ETFs that are a little more stable than the S&P 500, as well as pay higher dividends than the S&P 500. So let's go over why I chose these to be a part of my higher yield savings account. First is VIG. You can see the dividend yield is right here. The expense ratio, 0.06, is pretty low. The main thing here is that it's currently down 11.84%, which is about 1% less than the S&P 500. And you can see it has 186 holdings here, and its largest holdings are Microsoft and Procter & Gamble. The goal of this fund is to track U.S. Dividend Achievers Select Index. So that means they want to track companies that are consistently raising their dividend and also present a growth opportunity. And while they do this, they also provide a little bit more stable index than the S&P 500. For comparison, here you can see the S&P 500. It's currently down 12.7%, which is a little bit more than VIG, which I just mentioned. However, the yield is just a little bit higher, and the expense ratio for this fund is also a little bit lower. Moving on to the midterm bonds section, you can see here it is not down despite anything that's going on in the markets right now. These are organized by yield. So Vanguard Intermediate Corporate Bonds have a yield of a little bit over 3%, and they have a cost of 0.05%. These are midterm municipal bonds. They have a yield of about 2.25%. However, they are tax-free. And then these are midterm government bonds, 3 to 10 years, and they have a yield of a little bit less than 2%. Moving on to bank balance sheet section. Again, you can see here the return is currently up overall. It's over 70% mortgage-backed securities. Here are some 7 to 10 year treasury bonds, and then again, some municipal bonds. But this one is majority mortgage-backed securities where they invest in mortgages, and it currently pays 2.5% with an expense ratio of 0.05. Overall, this section has done well. Moving on to Realty Income Corp. I've talked about this position quite a bit. It is down from the highs. It was at about $80 prior to the market drop, and it's currently sitting at $51.79. My price per share is a little over $60, and the current dividend yield is 5.4%. I do like this company a lot. They have over 6,500 properties right now, and they have continued to pay their dividends through this Rona situation. And I believe this company will appreciate into the future. And this is my real estate holding for this higher yield savings account. Here's the general bonds section. It's made up of mostly aggregate bond indexes. So AGG and LQD are both aggregate bond market indexes. Both are investment grade. These are long-term corporate bonds. These tax-exempt bonds are municipal bonds again. And the most interesting holding here is ANGL, which is a Fallen Angels fund. These are bonds that used to be investment grade. However, the company has come on some hard times and they had to issue some higher yielding bonds than investment grade bonds. So the yield here is going to be a little bit higher. So AGG has appreciated a little bit more than LQD. However, LQD offers a higher yield. Long-term bonds offer a higher yield than either of these at about 3.5%. These are currently sitting at about 2.5%, and this one's at about 3%. Tax-exempt bonds are at about 2.25%, and ANGL is at 4.8%. So it's a pretty high yielding fund, but that is because these companies are considered to be more risky than they once were. And then extended treasuries are 20 to 30 year duration bonds, and that yield is at 2.66%. All right, moving on to these last 5 holdings. Long-term corporate bonds are corporate bonds of 10 years or longer. IDV, this is an interesting one. It's the highest paying dividend shares from Europe, Asia, Canada, and the Pacific. Currently pays 9.5%, and I did enter this position after the drop, but it does cost about 0.5% to own, so it's a pretty high cost ETF. However, it does yield about 9.5%, which is extremely high. Moving on to Drogo. This one is very similar to the VIG. However, it focuses on different companies. Its largest holding is Apple, so it is slightly different from the VIG that I mentioned before, which is the largest holding in this portfolio. Vanguard Value and Vanguard High Dividend Yield. I also entered these positions after the drop, so that's why they're down just a little bit. However, I'm hoping that they will hold their value, as Vanguard True Value is the largest holdings in the S&P 500. So it's more like the S&P 350, and then these are the highest dividend paying companies from the S&P 500. They did drop a little bit more than the market, which is why I scooped them up, and we'll see if that theory holds into the future. So what are the takeaways? High yield savings, get yourself one of those. Those are basically free money. You put your money in there versus a regular savings account, and it will grow faster. Worthy bonds is about a 5% return, as we talked about. I do consider this to be more risky than high yield savings. There is a chance that Worthy could lose money. However, they have been stable for me so far, and I've been able to withdraw money successfully. And then market-based savings. This is kind of an emergency savings. I'm trying to get some growth out of this money instead of having all of this money stuck in a high yield savings. But together, I have enough money if there's an emergency situation. I could liquefy all of these Worthy bonds, and I could liquefy all of these assets if I had to. But I have enough money in high yield savings for very short term, Worthy bonds for like the next 2 months, and then market-based savings for the next 2 months. So I have about a month here, 2 months here, and about 2 months here as needed. And this allows me to kind of grow my money at scale. I have the lowest returns in the high yield savings, but the most safety, medium returns, medium safety with Worthy bonds, and then the least amount of safety, but the highest potential for rewards with market-based savings. And that's my philosophy. And I like this philosophy because it allows me to have between 5 and 6 months of savings, but feel like I'm still getting some growth out of that money instead of having a pretty large portion of money just set aside waiting for some potential emergency in the future. This way I can at least get growth out of that money and I won't lose money to inflation. Of course, this is all my opinion. Consult your financial advisor before making any decisions. This is all for entertainment, and your results may vary. Please like and subscribe if you like content like this. So with that, let's get to the jelly. So today's jelly is the new Assassin's Creed. I've been a really big fan of the Assassin's Creed series ever since the very beginning. The Ezio trilogy in the beginning, if you're familiar with the series, was the first 3. And I played those all the way through from start to finish as soon as I could get them, and I enjoyed them very thoroughly. So the latest installment of Assassin's Creed is Valhalla, which is focused on the Vikings. As you can see here, they are a pretty brutal culture, and the trailer looks pretty awesome. So here's a little bit of what that looks like. I think that looks pretty sweet, and I'm excited to get my hands on that. The Vikings are a pretty interesting culture, and I always like the way that Assassin's Creed really blends history with, action adventure games. So, anyway, thank you for listening. If you made it this far, please like and subscribe, and have a great day.